What's going on, guys? Welcome to my first official YouTube video. As I'm sure you saw by the title of this video, um, it's going to go over what a financial market means, different types of financial markets, such as stocks, currencies, crypto, and index funds. It's also going to go over technical and fundamental analysis. So I'm actually going to cover futures, commodities, and bonds in another video. And just a quick little disclaimer here. I really only trade stocks. I know certain things about different markets, but I am not experienced enough to give advice about them. And so this channel will mainly cover stocks. This video is more just for an overall look into, well, a financial market. So also, I am not a financial advisor, nor am I telling you what to do with your money. I know that is a big, well, obviously a big part of the financial markets. There's a lot of money at stake, and I'm by no means telling you what to do with your money. All right, well, with that being said, let's get into technical and fundamental analysis. So, fundamental analysis is really more used for long-term investors and traders. It's basically looking at articles, balance sheets, and income statements to determine whether a stock or currency would be a good idea to hold. While generally, technical analysis is more looking at a price chart of a stock to determine a good entry point and exit price point. Technical analysis is more often used by day traders who buy and sell stock on the same day, or short-term traders who only hold for a couple days or weeks at a time. Okay, currencies. So some of you who might be a little more familiar with the markets might know currencies instead as Forex or foreign exchange. I'm going to be referring to it as Forex, but just note that all these mean the same thing. They're just different names. All right, at this point, if you're like, Nick, what the heck are you talking about? Don't worry, I will explain what all of this means. In the Forex market, you'll see that currencies always trade in pairs, and I will bring these up here. So here I just went to the markets, the currencies, and we'll just take a look at the euro over the US dollar, or euro to the US dollar. So here you see this is the chart of the euro to the US dollar. So in the Forex market, every currency you'll see will be able to be traded in pairs. So right up here, what I just highlighted, this is the euro to the US dollar. They're always traded in pairs. I mean, there's other ones too. There's the Japanese yen, the Swiss franc. They're all they're global currencies. So basically, what you're looking at here with the pairs of currencies and this value right here is how much of the second currency it would take to buy the first. So in other words, it would take about a dollar and let's say about $1.21, as you can see right here, to buy 1 euro. It's just kind of like the value relative to each other. So at this point, you might be asking me, hey, Nick, well, then what is this price chart that we're looking at? I mean, it just looks like one big squiggly line. Well, this is over a period of time how much this price has fluctuated. So if it's gone up, you'll see a nice upward spike here, and then it could come back down. So what drives this price up and down? What fluctuates it? Well, what it really is just demand there is for a certain currency relative to the other one in that pair. So in this case, if the demand for the euro goes up, that would drive the price up, and vice versa. So if the demand for the euro was a lot further down, it would decrease in value, and you would see this price drop. So let's just take a look right here. So from this point to this point, the value of the euro increased. Well, right at this peak here, it dropped off. So from March until, well, late March, it peaked and then it just came back down because of the demand. Okay, so cryptocurrencies. You've probably heard of them. That's things like Bitcoin, Ethereum. The new one is Dogecoin. So I know that the word cryptocurrency might sound a little like sophisticated and advanced, but essentially what it is a virtual currency like the US dollar, except it's exclusively virtual. And the word crypto comes from the fact that cryptocurrencies are encrypted, which this ultimately leads to better security and less counterfeit. Although keep in mind that cryptocurrencies aren't actually backed by the government. So this basically means, unlike a U.S. bank, excuse me, unlike a U.S. bank, they're not insured by the FDIC. So with that aside, the price of the cryptocurrency relative to the price of, well, in our case, this would be, so my apologies, I had the wrong chart pulled up there. So like I was saying, this is the price labeled here. Yes, I know it says 33 grand, which is a lot of money for one Bitcoin. So that's relative to the US dollar. So if I wanted to buy one Bitcoin, it would take me 33 grand in US dollars. So the reason you're probably blown away by 33 grand, this number here, is because, wow, that's a lot of money for a currency. And yeah, it is, but that's all relative to how much the demand of the currency is. Well, in other words, how many people want to have Bitcoin, and versus how much Bitcoin there really is, because it, just like the way you can't print money without ruining the economy, it kind of goes the same for Bitcoin and other cryptos. Okay, now we are getting into kind of the bulk of this video, which are, well, the stocks. So I have the US stock market pulled up here. And so what is a stock? A stock is, when someone refers to a stock, it's really the collective shares that represent ownership of a corporation. So I know that probably sounded really, really nerdy. So when I say the collective shares that represent ownership of a corporation, so a single share is a fraction of equity in a company. You know, if you ever watch Shark Tank and you hear Mark Cuban go, "Hey, I'll offer you 100 grand for 40% equity in your company." What he's really saying, and what this means, is he's gonna pay that person 100 grand to own 40% of his company. Now, don't get me wrong, one share of a company will not get you 40% equity of that company. It's a lot less. So you're never gonna own that much of a company. Even though you won't own that much of a company, you technically are owning a piece of that particular corporation. So when a company goes public or has its initial public offering, also known as, and you'll see this a lot, the IPO, which it just stands for initial public offering. So that means that the public, which would be us in this case, are able to buy and sell shares of that stock in order to have equity in that company. Um, I mean, as you can see here, obviously the chart I have up here is Apple, but if you see this right down here, it says AAPL stock chart. So this is Apple's ticker symbol. Now, what a ticker symbol or ticker is, it's basically just a sort of a nickname for that company in the market. And you don't have to worry too much about it because when you search up a company on most charts and brokers, um, if you search up just the name of a company, you can just type in the name and it should come up. This is more if you see like an alert or sometimes a news article, and it says AAPL. That's just, now you know that's referring to Apple. Okay, so unlike the Forex market, in the stock market, you're trading shares of a company. And so right here, you'll see the price of one share. So one share of Apple costs $134.14. You'll sometimes hear this as the stock price instead of like a share price. It just know they mean both the same thing. So overall, just like the forex market, it's really supply and demand of these shares that determines whether it's going to move up or down. And so, unlike the forex market, where people are buying shares of the company, that causes the price to go up, which is when, so buying shares in this case would be the demand, while people selling the shares would be the supply. So when the demand overwhelms the supply, you'll see the price start to go up, and vice versa. So if you see from this point right here, the selling price, or not the selling price, but people selling shares starts to increase, well, that means the demand will go down. This ultimately leads to the value of each share dropping because not as many people want to buy. Instead, they want to sell because they don't like the company or other reasons. Well, that pretty much wraps it up for my first official YouTube video. Before you go, though, it would really, really mean a lot to me if you put a thumbs up on the video, only if you enjoyed it. If not, I mean, feel free to leave a dislike and comment why down below. I really urge you to keep in mind, if you did enjoy the video, that I do put a lot of time into these. Right now I'm trying to balance school and sports along with this, so it would be much, much appreciated if you showed your support if you want this series to continue. You know, we've really only scratched the surface, and there's a lot to learn about the financial markets and the stock market mainly. And I mean, I have plans for more videos, but I am going to require you guys' support if you an interest in these videos if I'm going to keep making them, you know. So, but don't get me wrong, I enjoy making these. I'm definitely up for making more of them. And so yeah, take care, guys.